Okay, hi everyone. So welcome back to our another meeting. And before we move on to our pitches, I just wanted to share some of the news. And today I actually wanted to focus on one of the reports that was published by US SIF, which is basically a US membership association for professionals, firms, institutions, and organizations engaged in sustainable and responsible investing. And basically, every year, like usually every 2 years, I think they release this trends report, which is basically the most comprehensive study of sustainable and impact investing in the United States. It provides data on US asset management firms and institutional asset owners using sustainable investment strategies and examines the environmental, social, and corporate governance issues they consider in managing their portfolios. And so basically what this report has found, which was very interesting, you can actually look through this executive summary. So this is like a short version of the report, but you can go to their website and download the full version. And it's very detailed. And as you can see here, like the total US domiciled assets and management using sustainable investment strategies grew from 12 trillion at the start of 2019 to 17.1 trillion at the start of 2020. And that's like 42% increase. That's a lot. And that's, again, considering at the start of 2020, and you know that 2020 has really accelerated that trend. A lot of firms have transitioned to incorporate sustainability strategies within their companies, have been issuing different sustainable bonds. So it really has grown. And this basically means that 33% of all total US assets under management have some kind of sort of ESG strategy or sustainable responsible investing strategy. So this really shows that it really has increased. Yeah, if you look at this report, there are a lot of good insights that you can find. For example, this one lists top specific ESG criteria for money managers, for example, like climate change, which does make sense, anti-corruption, board issues, sustainable or natural resources, agriculture, executive pay. So if you do have time, just look through this. It's very useful. Say last time they released it was in 2018, so a lot of good information. It was just released yesterday, so definitely take a look. And another thing that I wanted to mention before we go into our portfolio. So if you are interested in becoming or on being on eBoard next year, you should consider taking this course at Bentley FI 316, which is basically a sustainable, responsible, and impact investing course. Basically, everyone, all eBoard members should take it, has to take it. Several eBoard members this year are already taking it, but I know there's registration. So if you have an elective, definitely I'll encourage you to take this one. But yeah, Mohsen, I think I will pass it on to you to give some updates about our portfolio. Is he? Oh, he's not here. Okay. He's probably having trouble to log in, I'm assuming. All right, then if nobody else has any other questions, or actually I'll give it a chance. Has anyone any other news to share about ESG? I know we haven't done this in a while, but if anybody else wants to share some news, feel free to do so. And if not, then I will let energy sector analysts to do their pitch.
All right, 1 second, guys. We're having an issue. It should take 2 seconds here to. All right, if it's cool, Victor, do you guys mind pitching? I think some of the file links in our Excel or our PowerPoint are broken, so we gotta fix them.
Yeah, of course.
All right, cool. Thanks, man.
Yep. So should we have sharing rights or no?
Yes, you do. Mhm.
Awesome. Can you guys see the screen?
Yes, we can see your screen.
Awesome. All right, so my name is Victor. If you guys don't know me, I'm pitching together with Emily. Today we're gonna pitch Cummins. So Emily, why don't you start us off and talk a little bit about the company?
Yes, thank you. So Cummins, it's on the New York Stock Exchange under CMI. Some ESG factors are, it currently sells for $228.45 with a price target of $244.08. ESG factors include Cummins takes a broad approach to sustainability, including the environment, corporate responsibility, health and safety, diversity and inclusion, innovation, customer service, and good governance, ethics, and financial performance. Catalysts they're an industry leader. They made a 2019 climate change strategy, Planet 2050 commitment, which I'll talk about more in depth later on. Electrified power performed via hydrogen fuel cell trucks, and they've just initiated the Action Committee for Environmental Sustainability. With that, some risks are regulatory requirements governing emissions and noise imposed by the EPA and EU. And additionally, the international markets suffer a significant downturn during slower pace of economic growth and weaker demand. So moving on to the company overview. In addition to building the cleanest, most efficient engines and power systems, the company introduced a strategy to address climate change in 2019. Yes, this unveiled the electric power performance for buses and created a concept hydrogen fuel cell truck as Cummins develops that concept. The company helped the clean cruisers demonstrate low carbon adventuring as they planted trees across Central America, powered by their Crate engines using biodiesel. And they did this last year for their 100th anniversary. The company was founded in 1919 and headquartered in Columbus, Indiana. They're led by Tom Linebarger, who joined the company in 1998. He was named the COO in 2008 until becoming the CEO in 2012. Under his leadership, Cummins has created a corporate governance of nominating committee charter. This consists of 3 board of directors. Additionally, Cummins has a strong commitment to diversity and inclusion. So currently 50% of the board of directors are women, and diversity and inclusion has been a part of Cummins' core values for over 40 years, dating back to CEO Irwin Miller, who led the company back in 1947. He initiated the company's first ever diversity and inclusion strategy. So it's been a long time in the making, but they've seen great success with it. So currently, their commitment to diversity has been recognized by a number of organizations and publications. Diversity Inc. named Cummins to its list of the top 50 companies for diversity for the 12th consecutive year last year in 2019. And for the last 14 years, Cummins was awarded a perfect score in the 2018 Corporate Equality Index by the Human Rights Campaign, which is the largest US civil rights organization for lesbian, gay, bisexual, and transgender employees. And they made the Dow Jones Index for most sustainable companies in North America for the last 14 years as well. So next, their post-pandemic plans. Cummins plans to continue its long-term opportunities, enhance its safety procedures, and implement a new safe work playbook. In the last sustainability report that came out last July, Cummins initiated a new CARE strategy to fight against the racial injustice that we've seen recently. So CEO Tom Linebarger promoted this opportunity for the company, aiming to mitigate social injustice. Cummins is committed to actively fight against systematic racism, continuing the company's longstanding history of promoting social justice. So this strategy includes a $250,000 commitment to the Urban League initiative, where Cummins is going to partner with another company, Eli Lilly and Co. Cummins has also committed to invest in a more diverse pool of suppliers using industry influence to support their growth. So under the CARE strategy plan, it focuses on 4 main areas, which are to achieve police reform, realize criminal justice reform, create economic empowerment by building Black wealth income, and drive social justice reform and healthcare, housing, workforce development, and civil rights, including voting rights and education. Next, industry outlook.
All right, awesome. Thank you, Emily. So let's talk a little bit about the industry and what Cummins actually do. So up to the left, you can see a diagram of their products and service segmentations. So their biggest revenue driver and biggest revenue comes from their engines, mostly diesel. So you can find it in big trucks, Ram trucks. These engines are used in highway vehicles, for example, freight trucks and machinery. The industry has seen a lot of volatility the past 5 years. That is mostly due to a lot of macroeconomical factors such as oil price, international trade. The company is also very exposed to currency fluctuations since it's a very global company, and I know they have more than 50% of the revenue outside of the North America. So for example, when oil prices fell, oil producers shut down the rigs and they put off purchasing new equipment, and consequently demand from these downstream operators declined, and that really hurt companies like Cummins. But over the 5 years coming up to 2019, the industry revenue is expected to fall at an annualized rate of 4.4%. Yeah, let's talk a little bit about the key drivers. So the high levels of industrial production generally lead to increased demand for heavy-duty engines, as machines use these engines to make industrial products. The trade, a lot of the products and a lot of the things that are happening in the industry comes through trade, and as we all know, there's been a pretty heavy trade war between China and the U.S., which has also hurt the industry. So as the trade weighted index decreases, exports become more competitive as the dollar depreciates. But it is expected to increase in 2020 and 2021. We can also see the major players. Cummins has about a 20% market share next to Navistar and Caterpillar. This is, I want to point out, this is in the heavy-duty diesel engine manufacturing. Cummins do a lot of different stuff too, but this is by far the main segment. So moving on to industry outlook. The industry, we believe, are looking at a lot of R&D investments to improve efficiency and to work with regulators and so on. I'm going to talk a little bit more about that, but industry players that invest in R&D to create more fuel-efficient engines will probably be more competitive. And as we've seen through our research, is that a lot of the large players buy up smaller niche companies. So there is a lot of consolidation going on in this industry. A little bit about the company trends. Cummins is spending a lot of money and a lot of R&D and time and resources into developing new technology. to increase fuel efficiency and to meet regulation demands. They have done a lot of stuff with hydrogen production technologies, which is where their main focus is right now. These engines are coupled with an alternator to generate power as and when demanded. I'm not really good engineer, so I can't really describe it well, but they are a lot more energy efficient. And at the end of the day, Cummins is working with diesel, which is not super environmentally friendly, but they're also moving away from it and really trying to develop and put a lot of money and time into R&D. And to develop electric trucks, they're working to focus on battery systems and so on. So like I said, there's quite a bit of risks associated with not only the company, but also the industry as a whole. You're looking at regulatory requirements governing emissions and noise imposed by the EPA and the EU. This is not something new. So we think that the Cummins is, with their experience, really well positioned to combat these requirements. And you know, it's nothing new to them. They've been around for 100 years, so they work closely with regulatory and governing bodies to meet their needs and to work with our planet to make their emissions lower. So international markets suffer a significant downturn during a slower pace of economic growth and weaker demand. We talked a little bit about that. That also goes into COVID-19, oil prices. Something else that Cummins does is that they collaborate a lot with their customers and also partner with competitors to really develop products that are good for the environment. They, like I said before, they take a lot of niche companies and they merge or acquire them just to get the knowledge and brain power to create new stuff. If we look at ESG influence, their main focus is safety, environment, and technology. They do have a committee and committee of board of directors. They meet, I think it's quarterly. And they also have an annual submission to the Carbon Disclosure Project, and that is for climate change and water. And like I said, safety, environment, and technologies are their main focus, and I'm sure Emily is going to talk a little bit more about that right now.
Okay, so for ESG analysis, Cummins primarily focuses on the release of their greenhouse gas emissions, their Planet 2050 strategic plan, and the company's diversity and inclusion initiatives. So for greenhouse gas emissions, they created the Action Committee for Environmental Sustainability, formed in 2012 at Cummins, which integrates climate change action to overall business strategy. The execution sponsors and is head of this group, reports up to the Chief Technical Officer. The group is the voice and catalyst for environmental action beyond compliance in the company and provides tools and resources for the company or for the employees to go further and faster in reaching environmental goals. This committee plans to combat greenhouse gas emissions by innovating carbon neutral technologies that address air quality and designing out waste in the company's products and processes. I'm going to get to 2050 and more on the diversity in the next couple of slides. But the third-party data includes, they have a Bloomberg disclosure score of 86, an MSCI rating of AAA. They were ranked top 14 on the corporate responsibility best corporate citizens list. For the 14 consecutive years, made the Dow Jones most sustainable companies in North America. They were 21st in the Forbes top 24 employers in America and named to top 50 companies for diversity by Diversity Inc. So before achieving their 2050 planet goals, they set 8 2030 goals that are imperative to achieve to to be successful in 2050. So the first four 2030 goals focus on climate change and air emissions, which are to reduce greenhouse gas emissions from facilities by 50%, reduce 25% of greenhouse gas emissions from newly sold products, partner with customers to reduce scope 3 greenhouse gas emissions by 55 million metric tons, and reduce organic compound emissions by 50%. The second four goals focus on natural resources in the most sustainable way. So that will be recycling the materials and parts used in products, generate 25% less waste in facilities and operations. They have the goal to recycle all packaging plastics, and then reduce water usage in facilities by 30%. So those 8 goals as a stepping stone will help them to achieve the new environmental strategy of Planet 50. This includes science-based goals that meet or exceed the goals of the United Nations Paris Agreement on climate change. So Cummins' next generation environmental sustainability strategy looks out to 2050, settling quantifiable goals for 2030 along with visionary long-term aspirations for 2050. This will benefit both the company, community, and all of the stakeholders involved, and the strategy mainly focuses on reducing the greenhouse gas and air emissions in line with expert recommendations, using natural resources in the most sustainable way possible, and helping the communities address major environmental challenges. So next, this quote was said by CEO Tom Linebarger over the summer, and it just really represents Cummins' mission as a whole. So in 2019, their sustainability report accomplished reaching 3 out of 4 of the company's 2020 environmental sustainability goals a year early, and the 4th was very narrowly missed, but they plan to meet it by the end of this year. They've offset nearly all of the company's energy use in Cummins headquarters, state of Indiana, with renewable energy, thanks to a wind farm expansion that the company supported and funded. They achieved the lowest health and safety incident rate since 2015. They reached the 50% level for women representation on the company's top senior leadership team. They impacted the lives of 100,000 people through the company's global Women's Power program to promote equality. They have invested a record $1 billion in research, development, and engineering as the company advances current technology and brings a new product to the market, fueled by hydrogen and other low carbon energy sources. And they did all of this while achieving record profitability for the year.
All right, moving on to valuation. Starting with comparative company analysis. So like we said before, Cummins is really operating in a lot of different segments. So it was kind of hard to pick and choose what kind of comps to use, but those are the 6 comps that we came up with. And as we can see in the first, in the top table, they do have higher EV over sales, EV over EBITDA, and EV over EBIT. That's the valuation that I got. I did go into Bloomberg and found an industrial classification benchmark, which had about, I think it was 25 parallel companies. And we see that the numbers are a little bit more favorable for Cummins. Definitely nothing crazy, but I think we should have more trust to the one Bloomberg has, because it has a lot more comps. But yeah, moving on to key assumptions. As we can see, tax rate, that is their effective tax rate the last 2 quarters. Discount rate got from Bloomberg and did an average between Bloomberg and FactSet. Perpetual growth rate, we believe 3% is reasonable right now. And as we can see here, this is their compounded annual growth rate the last 5 years. It's been about 5%. However, the industry has shown a lot of volatility in general, mostly due to the oil prices and market demand. Some really good news was in their Q3, they beat their EPS by 36%, and they were 14% higher in revenue than the analysts forecasted, which is good. I think we're taking a relatively conservative stance because of the volatility in the market and the volatility in this industry and uncertainty in trade and a lot of factors that affect this particular industry. If you look at analyst recommendations and analyst outlooks, the most bullish analysts are up towards 275 and the most bearish is 175. So we can see that there's a very big gap in what analysts believe. But also, like I mentioned before, this is a pretty mature industry, so we're not going to see any crazy growth rates in general. But they have grown slower than the market in the past 5 years, but so has the whole industry. So moving on to the DCF. Pretty straightforward. This is what we got, an equity value in 1 year of 244.08, which we feel is definitely reasonable and goes along with the revenue and the key drivers for this industry. They are going to have a tough year, but we do believe in a strong bounce back, and mostly due to their experience with dealing with stuff and just being 100 years old. They've been through this before. They have a strong balance sheet, and they do have a lot of cash on hand. So we believe they're going to make it just fine out of this. So price targets, our base case is 244.08, which is the 7% upside. We believe that's reasonable. That's 15% decline in revenue this year, and over the next 5 years, that's going to be a 4% growth in revenue, which is pretty conservative, but like I said, that's what we believe. Bull case 268, which is a 70% upside. That is if a lot of R&D expenditures goes well and they move along well. Bear case 206, that is with 2 negative years of revenue and a 2% revenue growth after that. To the right, we can see some analyst recommendations, and we feel that they align pretty good with what we came up with. We have ranges from 230 to 267, and a pretty strong consensus rating. So to conclude, we are confident that Cummins will utilize their experience and market position not only to recover from the pandemic, but also to continue to be an industry leader in innovation and technology. The company has comprehensive and transparent ESG plans and works intensively with regulatory leaders and partners to produce sustainable products. We believe that Cummins has and will continue to produce strong financial results and should be bought at 228.45. Thank you.
Great. Now, any questions from anybody in the audience?
I have a question. Does the fact that they make like diesel or engines factor into like your greenhouse gas like measures, or is that just the production side, like how much gas they used to actually make them?
What?
Could you say that one more time?
Like, I know you were talking about like greenhouse gas, I'm pretty sure, for like one of the sustainability metrics, or So does that like, are you considering the fact that their products also create or burn fuel?
No, I think it's just based, measured on their facilities and operations, not the actual products.
Thanks, guys. That was a great pitch. I just had a question for you guys. I was just Googling Cummins and I saw they had a hydrogen day yesterday that they posted. I was curious if you guys had any information on that.
No, but we can definitely look into it. I don't.
Yeah, thanks. It looks like there's a lot of news about it. Would be cool to know. Thanks.
Yeah, absolutely. That's, like you said, that is where they put most of their R&D and efforts, and they're looking to move away from diesel engines. But you know, it's really hard for them right now because it's obviously their biggest revenue. But definitely gonna look. I actually missed that too, so thank you for bringing that up.
Any other questions? If not, I will let Energy Sector to present their pitch. But if you do have any questions, feel free to contact analysts like Victor or Emily on Teams. So, but Max, you can try to share your screen now. Hopefully it works.
Sure. Yeah. Give me 1 second here. I'm just gonna move something around. It should be all set. All right. Can everybody see that?
We
Yep.
can see a screen where it's, oh yeah, perfect.
All right. Just gonna load in. All right, guys. This is Energy Sector. Well, energies, utilities, and infrastructure. Today we're focusing on a water utility, being Evoqua Water Technologies. So I'm Max, and Isaac is here with me. Isaac, you gonna chime in?
Yeah, hey guys. I'm Isaac, so I'll be doing this presentation along with Max.
Cool. All right. So we covered this last time. Basically, in summary, the goal of our sector is to cover renewable energy, water utilities, another thing, transportation, infrastructure, other things. Water is one of, if not the most important commodity out there. We chose this company, Evoqua, because we believe it's the future of water and the future of the way that wastewater is treated, the way that commercial water and industrial water is treated as well. And we'll go over some of the technologies that they use, which are the future of this industry.
Start off with a brief business overview of Evoqua. They're a company that provides water treatment equipment and services. They're really committed to protecting water across the United States and in a couple other places throughout the world. They provide products and services for treating industrial, commercial, and municipal wastewater, as well as services that purify drinking water. They're currently the market leader in North America, and the majority of their business is done in the United States. Their ticker is Evoqua, and they're currently trading at 25.5. They're on the upper end of their 52-week range. They've really seen big price movement since they reached their bottom in March. They have an EV to EBITDA of 13.34 and a beta of 2. So they are a relatively volatile stock, but we believe that, over the next couple of years, they're going to have steady growth and that beta is likely to decrease. Their CEO is Ronald Keating. He's been CEO for the last 6 years. And as a company, they're really focused on increasing community involvement through volunteer projects, decreasing water usage across the country, as well as within their own um, within their own facilities, and creating more board diversity. So to continue with the overview, they currently provide their technologies and services to about 25,000 customers and have a little over 200,000 installations worldwide. The ESG factors that we're going to be focusing on mostly are their ability to reduce their water consumption at their facilities, and they've decreased it by 26% since 2017. Their anaerobic digestion systems also produce energy and power about 5,000 homes a day. And then on top of that, they provide smart metering, water recycling, energy from waste, and as I said, they're focusing on board diversity. Our price target for Evoqua is 29.17, and the catalysts that will contribute to this growth are a continued transition of customers to a higher value added and more predictable service-based model. They're going to commercialize and drive adoption of newly acquired technology through mergers and acquisitions. And through these mergers and acquisitions, they're also going to enter into new geographic markets as well as technological markets. Some risks that may hinder the growth of Evoqua is their growth is really dependent on their M&A strategy. And so as long as they can continue to acquire smaller companies and move into new geographic and technological areas, they're likely to see more growth. However, that could be hindered by a decrease in M&A activity. New environmental laws and regulations could impact Evoqua. However, the way that the environmental laws and regulations are trending right now, it's more likely that they'll benefit Evoqua. And then a lot of their new business model depends on their ability to acquire new technologies. And so their ability to keep up with product innovation through acquisition of new technologies is really important to their growth.
All right, so for their business overview, a couple of things about their operations. So they serve $16 billion of an $85 billion addressable market, which means they have pretty substantial market share, and they actually are pretty confident in the fact that they'll be able to capture a significantly more of that in the future. Primarily, though, they believe that that's going to happen through tuck-in acquisitions, which will give them exposure to new geographies, and that's something we'll touch on later. They've improved their net leverage from 4.2 to 3.1, which is good, meaning that they've decreased their net debt. They're 4 times the size of the nearest competitor. They classify themselves pretty niche, actually, based on the service side of their business. So they basically say that they only have a couple competitors, but there are some others that are much bigger, but we'll go over that in the comps, what I mean by that. So they have 97 US service branches and a 20% EBITDA margin. So they break down their revenue into 2 types, and that's by products and services. So for the products, that makes up 59% of their revenue, services 41%. And when you apply that to their actual business segments, being their applied product technologies and integrated service solutions, you can see the revenue there, 63 and 37. So their 2 solution sets, or product and services sets, are the applied product technologies and the integrated solutions and services, like I said. Within applied product technologies, they have wastewater technologies, being the meters, the facilities, things like that, et cetera. Disinfection, that being primarily one of their newest things. They acquired a UV disinfectant company that purifies water using ultraviolet light. It's a new technology, and it shows a lot of potential for the future. And they did that actually in the last year. They do aquatics, so they also do products and services for whether it be like aquatics for large pools, or they also do a lot for aquariums. So they won an award for a sustainable project they did at the Georgia Aquarium in Atlanta, which is one of the biggest aquariums in the world, which is pretty neat. They also have electrochlorination, which is a pretty advanced process that you use to basically purify water by separating it. and then advanced filtration and separation. And they sell and produce tons of products in regards to filters, pumps, etc. For their services, services is really where they're looking to go for the future. When you see revenue by segment, you see the solutions and services is 63%. The on-demand services, operating services, preventative maintenance, and Water One services are their main services. The big one to highlight here, which is huge for the company, is what's called their Water One services. And what these Water One services are is it's basically actually SaaS, software as a software for smart metering, and they're outsourcing water management, and they're handling it. So instead of like a wastewater plant handling their own water management, they outsource it to Evoqua, and then Evoqua handles all that, and then charges them an initial fee, and then it's over a contract, and then so it's a great source of recurring revenue. And what they're trying to do is get a lot of their customers over to that business model because it would be a lot more predictable for them. But as you can see, they have a big solution set here. In terms of value creation and growth, one of the biggest things that they've done recently would be a ton of M&A activity. They've been pursuing a creative tuck-in acquisitions, basically just to add new technologies, new geographic regions, and also new end markets. For example, one of the new end markets that they're looking to get into is the microprocessor and microchip production. So really advanced technology stuff that uses like heavy metals and other things and waters in the production and the treatment of those. As that's a growing industry and that's somewhere they want to head. So they're looking to drive margin expansion and cash flow improvements through continued focus on just running the business as it is and obtaining operational excellence. They've acknowledged the fact that there are a lot of things that they can do within their business to improve their cash flow and their margins. And it's just a matter of time until they do that. COVID really set them back with that, but in the future they're expecting a pretty good margin expansion of like 5-6%. In addition, they're also looking to further penetrate its existing customer base by offering more services and more advanced services. Also, too, they're looking to move into underpenetrated regions across the globe. So right now, about 85% of their revenue comes from North America, with 15% outside of that. But they do expect that to increase substantially, 5 to 10% in the next 5 years. In addition, their product revenue growth has been 6.1%. Service revenue growth has been 10.4%, and that's in line with their mission to significantly increase their amount of recurring revenue through bringing customers onto the new Water One service platform. And then otherwise, they're looking to their area of growth they've been doing really well on is healthcare, pharma, and biotech. There's been a lot of investment in that space and a lot going on with COVID, and they've gotten to pick up some of the currents in there. And that we'll touch on in an upcoming slide. So here we have industry outlook and competitors. So the first thing is aging infrastructure is one of the biggest drivers for investment in this stuff. And right now, the market has a pretty strong appetite for that, as a lot of the infrastructure in the United States is in misrepair or needs updating, or new regulations mean new investments have to be made. Another big thing is these smart metering systems are becoming a lot more popular across the industry. And fortunately, Evoqua has one of the most advanced and most used ones. And people are looking to increase efficiency. That's huge right now. And one of Evoqua's main goals is to improve efficiency and water use. So some of its major sites that it operates at, it's been able to decrease water use upwards of 25%, which is pretty substantial given the fact that they can do that. Some material factors, they're decreasing the cost of clean water. Innovation is the primary driver for that. They're increasing purification efficiency, new technology. The UV is a great example. And rebuilding old US infrastructure and developing new infrastructure overseas is another big thing. In terms of their competitors, you can see a couple here on the right: Global Water Resources, Middlesex Water, Idacorp, Pentair, American States, and Essential. All these companies basically deal in the same thing as water services and also products in the space. And some of the macro drivers I mentioned being aging infrastructure, regulatory environment, emerging contaminants. A lot of those contaminants are coming from technology and the production of new tech. Recycle and reuse is huge. There's a huge push for a lot of recycle and reuse of water, or something called gray water, if you guys know what that is. Also trade dynamics, that'll impact how they source their products. Consumer spending, not so much, but it impacts, majority of the economy anyways. Public health and safety is huge, especially with COVID and increased emphasis on public health and safety. These, some of the systems they offer will be huge for that, especially the UV stuff. And total water consumption too, it's increasing, and it will continue to increase as people move to urban areas and the population increases as well.
So to continue on with an industry outlook, although from 2015 to 2020, the industry saw a slight stagnation in revenue growth, bottom line growth grew by 3.8%, and that was largely a result of large firms acquiring smaller firms and creating greater efficiency, as well as acquiring new technologies. And this is a trend that we think we're going to see over the next couple of years, where these larger companies aren't as affected by the economic impact of COVID. And as a result of that, they've had opportunities to acquire smaller firms. Also, water price hikes. In 2019 alone, average water prices increased by 3.6% in 50 largest municipalities, which is outperforming inflation. And a large reason for that, as Max mentioned, is in America, drinking water infrastructure is extremely poor and is likely to needed to be upgraded over the next couple of years. The American Civil Engineers graded it a D, and a D plus for wastewater systems. So that's an opportunity for Evoqua to step in and have a role in updating this infrastructure. We also see a pattern of urbanization and suburbanization, which is expected to put a larger strain on water needs in cities. And we also see a trend of increased investment in utilities, as well as a rebound in commercial and industrial demand. In general, increased infrastructure investment and more stringent municipal, state, and federal regulations promote increased spending on water products, services, and solutions, while a slowdown in investment in public infrastructure or the elimination of key environmental regulations could result in lower industrial and municipal spending on water systems and products. So with that said, we see that there's likely going to be a large trend in utility scale investments over the next couple of years. And some of the key risks and the way that they mitigate these risks are, as I mentioned, there's a large impact on commercial and industrial demand in 2020 due to COVID. However, with that said, this is slightly offset by increased household water use as a result of people working from home. Another risk is the inability to keep up with product innovation that may cause Evoqua to lose a strong position in the industry. However, the company's key business strategy is acquiring new companies, and they've really been doing that quite often since 2016. And the recent economic downturn has actually given them the opportunity to acquire smaller companies that have been more affected by COVID. It's also a slight risk in changes in government regulations that could affect the way that the business operates. However, management of Evoqua continuously monitors regulations to ensure that they comply with them. And then a couple ESG influences are the higher demand for clean water due to the global water crisis and government's increased spending on water infrastructure to ensure better water quality, which is a trend that we're going to see over the next 5 years. And then this is a graphic that shows the impact that COVID has had on the different lines of business that Evoqua carries out. And as you can see, like, they really haven't had that much of an impact from COVID. A lot of their business segments are pretty resilient, just because they provide services that are always going to be in demand regardless of what the economy is doing. So we see this as a really strong sign that in the future, if there are more economic downturns, there's likely a lot of resilience to this within Evoqua. And then our ESG analysis, as I mentioned before, they reduced water usage at their primary locations by about 26% since 2017. And they continue to focus on ways that they can decrease it over the next couple of years. They enforce training for all workers and have decreased workplace accidents significantly over the last couple of years. They also have an independent board of directors and have recently added women to the board to create a more diverse environment. They treat 100 billion gallons of water annually and treat wastewater for about 500,000 people daily. They're rated a 58 on their ESG ranking, which is slightly above 17,000 other companies that are within similar industry. Although that might not sound significant, they are also recognized as a most influential company for sustainable future by SDG 2000, which is a list of 2,000 companies that are believed to have the greatest impact on the UN Sustainable Development Goals and whether or not they're achieved by 2030. So these are the SDGs that Evoqua themselves says that they're committed to serving through their daily operations. And then specific ESG material factors, environmental, as I've mentioned before, they focus a lot on decreasing water usage. Their anaerobic digestion systems produce enough clean renewable energy to meet the needs of 5,000 homes a day, and this is through a biogas source. They've also prevented the landfill of over 14,000 tons of carbon, and they've done that by having a carbon reactivation service that allows customers to reduce waste of carbon by regenerating and reactivating spent carbon. And they actually use this carbon to remove taste and odor from municipal drinking water. And it also removes chlorine from the industrial water processes. In terms of social, employees receive initial training followed by regular refresher training, which has resulted in total workplace accidents being reduced by 14% since 2018, and they're about 3 times below the industry average for workplace accidents. And then on top of that, all manufacturing sites have health and safety committees that regularly review the guidelines that employees need to follow in order to ensure safety. In terms of governance, their compensation is voted on by shareholders, and they're required to take the input of shareholders before determining executive level compensation. Executives are also prohibited from publicly trading Evoqua options, and over 50% of the board of directors is independent, including an independent chair.
All right, so here we have our comparable companies analysis. You see here the companies that I listed as the competitors prior. In terms of Evoqua in regards to its competitors, you can see that its financial leverage, actually the math's here a little off, guys, so my bad here. It didn't go through, but I know it off the top of my head. So basically, one of the big things is their net debt to EBITDA is a lot lower than their competitors, which is good, which we talked about earlier. They're working to pay that down. Their return on assets is pretty high, meaning that they get a really good investment on things they're doing. I think primarily because a lot of the things that they've been investing in have been like pretty, right off the box things they can get going with, like a lot of the businesses that they've invested in some of their new facilities. Their return on equity is the highest out of their peers, which is awesome. And their EV to EBITDA is 13. Moving here to the DCF, so the sensitivity table wouldn't load in. That's why I was having an issue at the beginning. So I just put in some of the assumptions I put here, and I can walk through those. Basically, ultimately, for the base case at least, we ended up getting okay, that's the other one. Yeah, sorry. Like my whole PowerPoint crashed right before this, so I was a little off. But yeah, so basically what we got is come here and I'll go back. Yeah, it's missing some things, like I said. But so for the bear case, we got $21.75, 17% downside. What we did is we projected revenue growth that was slightly below, actually significantly below this last 2020. They came out with their earnings this morning actually at 7, so we made sure to update everything this morning. So yeah, and then I think the other thing too is the big thing that's affecting them is when they do these, tuck-in acquisitions. One of the biggest things it does for them is they're bringing in new technologies as well. Sorry, guys. Yeah, one sec, guys. My computer's like really off. I should have had you do it, Isaac, the presenting. Let me just take this back. Come on, let's go. All right. All right, let's take us back to where we were in here. All right. So yeah, so basically our base case. So for our base case, I have the chart up here. So for our base case, so 2020, the revenue growth was 14%. And then we predicted that it would, they'd still have high, because this is pretty high for them. Given prior years, it was about 9-10%. However, they made a ton of acquisitions in the last year. And they've been moving a significant amount of their current customers over the recurring business model. So we'll expect pretty, substantial revenue growth in the next few years as they start to move all their customers over to this new model. However, we think that they can only do that for so long, and also too, another place for revenue growth is their geographic expansion. They only have so much target market left that they can capture. So eventually, the revenue growth will decrease, start to flatten out. However, also their cost of goods sold will decrease as they bring on new technologies, new innovation, new other things to allow them to provide their goods and services at a lower cost. So these are pretty conservative. That's what we used for our base. It gave us a $10 a 10% upside, bringing us from what is now $25 to $29. Like I said, strong short-term growth. COGS decreases over time. The bull case cut out here because my file got corrupt, I guess. But for the bull case, it was $40.57 what we projected, and that was like a 40-something% upside, which is pretty high. However, the reason for that is we believe that if they can continue to not only bring on new customers, but also bring them into this new system, and also they have new softwares they plan to bring out, new technologies they plan to bring out, if they can execute that all, perfectly well, there's a chance for huge growth within the company. Also, too, for that case, we had a higher perpetual growth rate, just assuming that the recurring revenues would increase substantially into the future, past the 2024. So that'd be the reason for that. And sorry, these slides are messed up, guys. So basically, in conclusion, though, Evoqua is a leading water technologies company. They have significant market penetration, some really great growth initiatives. The company's moves to manage water services is huge. It's industry leading, and it's going to benefit their business model substantially. Other factors, like a lot of those macro factors I discussed, increased government spending in water and infrastructure, increased regulations in their target industries as well, will increase the demand for their products and services substantially. What also is really great too about a company like Evoqua, it's relatively insulated from economic cyclicality, as the services that they provide are literally mandated by the government for the people that they serve. So there's always a strong demand. However, due to COVID, some of the servicings were delayed. So some of the service revenues will take a hit. But so yeah, and then a decrease in the quantity of potable water, increase in demand is huge. I think too, also the big strategy to acquiring companies, their recent 15 acquisitions, the move to foreign markets will be huge. And lastly, it holds a lot of long-term contracts with all of its customers. It's got over 25,000 customers, which is great. So low customer concentration. And these long-term contracts, guarantee steady revenues into the future. Though it's trading close to its 52-week high, we believe that they're positioned well for long-term growth given all of the initiatives that they've taken. And that is Evoqua, if anyone has any questions. Anybody, anything. Like literally, you can ask me my favorite color. I don't care.
I'll
Just
shoot
what-
you a question, Max.
Yeah.
What do you think about their debt levels? It seems like they're pretty leveraged. Is that the correct statement? And what would you say to that?
Yeah. So they had to take out debt to finance a lot of those acquisitions.
Yeah.
But they're working really hard, and they've been able to decrease their leverage. I believe their leverage was like 4 times in the last year. They got it down to 3, and they're one of their big focuses to pay that down right now. So I'm not worried about it. And that funded a lot of their acquisitions primarily.
And what is your favorite color?
It's green. Thanks for asking.
Okay, so if you don't have any other questions, I just posted a link to the voting form, and I will also add it to the Teams. So make sure to vote by Sunday night. Definitely encourage everyone to vote because that's how you're gonna get all the pitches. And but yeah, great. Thank you so much for everyone to coming. Since Tuesday. Yeah, that's it. And we'll see you next Tuesday. So next Tuesday, we're going to have a meeting. I know it's Tuesday before the Thanksgiving break, but we're still going to have 2 pitches. So don't miss that out. Thanks.